All right, the price of new cars is up more than 30% since 2020, and some car loans are stretching terms to 100 months. Joining us now, Sean Tucker, Kelley Blue Book managing editor, who's been writing about vehicle affordability. Sean, good morning. Obviously, the way it works for a lot of people in this country is they buy as much car as they can afford with a given monthly payment. So what are now the implications of this as we try to essentially extend the maturities and somehow accommodate these higher list prices?
So the 100-month loan is an attempt to address an affordability problem in the car market. The average new car in November sold for $49,814. We expect it to cross the $50,000 line sometime early this year and stay there. That translates to a monthly payment of $776, which is just not easy for the average American family to take on. It's near a record, not quite a record. If you remember during the microchip crisis, it's hit $795. But we do think it's possible we could see a record monthly payment next year. And with lenders and dealers can't bring down the monthly payment by changing the mix of cars that are built, but they can bring it down by extending the loan. The problem for the buyer is that a 100-month loan at today's interest rates will cost you about $5,100 more over the life of the loan than a 60-month loan would.
Is there any sense that this dynamic is going to restrain further increases in prices, or are the drivers of higher prices just, continuing to force the issue here? I mean, obviously, we know about, tariffs and a lot of the big cost increases on basic materials, but just the fact that, these are now, computers on wheels and they become more high tech and more features get embedded in them.
We don't see change on the horizon. A little bit of this is consumer choice. We're seeing near record numbers of luxury cars sold, and cars priced over the $75,000 line outsell those under the $25,000 line now. But all of the automakers have noticed that, and they've tailored their lineups to address it. So, for instance, in 2017, they built 61 models priced $60,000 or more. Today, it's 114. At the other end of the scale, in 2017, they built 36 models priced $25,000 or less, and today it's just 4.
Sean, I wonder, this tax change that I guess is retroactive and took effect this tax year, 2025, but certainly will continue next year, which allows car loan buyers to deduct up to $10,000 of interest on car loan payments. Did you see any impact from that after the tax bill was passed? Do you think that's going to be a tailwind going into next year?
We haven't seen terribly much impact from it yet. It's tailored narrowly enough that I don't know if it's going to have a significant impact. I think the bigger factor is really just the mix of cars that are being built.
So when you say it's tailored narrowly, in other words, it only applies to certain kind of buyers, or that $10,000 cap is not high enough?
A little bit of both. More that the $10,000 cap is not all that much in a world where the average car costs probably $50,000 or more.
Yeah.
And when it comes to this idea that, it's obviously consumer choice and they're skewing toward more expensive models and the manufacturers respond to that, is there not a bit of an opening somewhere else for a lower price line? Obviously, I go back to the time when Ford Escort was the best-selling car in the country.
Right. There absolutely is. And it's inevitable that someone is eventually going to figure out, I could build cheaper cars and have less competition. But we've seen very little of that yet. You may be familiar. There's a Jeff Bezos startup project called Slate Automotive that's trying to build a truck for under $20,000. I'm not convinced they're going to get there, but that's the first sign that I've seen of someone trying to address that market. But the major automakers haven't moved toward it yet, and they're making a lot of money not addressing that into the market.
And then on the lending side, the credit quality side, there has been a lot of, some evidence of uptick in delinquencies on auto in particular. Are there one-off factors related to, I don't even know what. I mean, people have even linked it to things like deportations. But I wonder if you think that that's going to be a continuing potential risk in the credit world.
It is a bit. There were a couple of prominent bankruptcies of subprime lenders last year that certainly played into that a bit. But we're not expecting a drastic change there.